What if I told you that most money doesn't exist as physical cash? In fact, the vast majority of it is just numbers on a screen. And what exactly is money? And how do economists measure it? More importantly, how can something be both unimportant and absolutely critical at the same time? In just 5 minutes, let's break it all down. Money is anything that people widely accept as payment for goods, services, or debts. It exists to solve a fundamental problem. Barter is inefficient. Imagine you have apples but need bread. You'd have to find a baker who not only has bread, but also wants apples. Money eliminates this hassle by acting as a common medium of exchange. But that's not its only role. Money also serves as a unit of account, providing a standard measure of value so you know how much something is worth. It's also a store of value, meaning you can hold onto it and use it later without worrying that it will spoil like apples or go out of demand like fidget spinners. But there is a paradox. On one hand, money shouldn't really matter. Economists sometimes describe it as just a veil over real economic activity. If the government printed twice as much money overnight, in theory, prices and wages would just double, and nothing real would change. But in practice, money is absolutely critical. One reason is that some prices, like wages, don't adjust instantly. If businesses suddenly face higher costs, they can't just slash salaries overnight, which means inflation or deflation can cause real economic pain. Another reason is that trust in money is what keeps the entire economy functioning. If people stop believing that money holds its value, they stop accepting it, and trade grinds to a halt. And finally, money isn't just a tool for buying and selling. It is a benchmark for comparison. Prices provide essential information that helps allocate resources efficiently. If the value of money becomes unstable, businesses and consumers lose their ability to make rational decisions, and markets break down. Throughout history, money has taken many forms. Commodity money, like gold and silver, had intrinsic value. But today, most economies use fiat money, currency with no inherent worth beyond the trust that people place in it. And the truth is, most money today isn't even physical. The balance in your bank account isn't a pile of banknotes stored somewhere. It's just numbers in a system. In most modern economies, less than 5% of money exists as cash. If money isn't just cash, how do we measure it? Economists use different definitions, called the money supply. The narrowest, M0, includes just physical cash and coins. M1 expands to include checking accounts, which can be accessed instantly. M2 goes further, adding savings accounts and small time deposits, money that's still relatively liquid, but not used for daily transactions. And M3 includes even larger deposits and institutional money market funds. You can think of it like expanding circles, M0 at the center with M1, M2 and M3 adding more layers of financial assets that function like money. But which of these definitions matters most? In practice, M2 is often the most widely used measure because it includes money that can be easily spent, but also captures savings that influence economic activity. However, it isn't the actual level of money supply that drives inflation or economic booms. It's the rate of change that really matters. If the money supply grows too quickly, inflation can take off. If it shrinks or stagnates, the economy can slow down, and in extreme cases, it can even cause a recession. That's why central banks don't just track how much money exists. They focus on how fast it's growing and whether that growth is in line with economic output. Understanding the money supply is critical because it affects inflation, interest rates, and economic stability. If too much money enters the economy, prices rise and inflation erodes purchasing power. If too little money is available, spending slows, businesses struggle, and the economy stagnates. That's why central banks like the Federal Reserve, the European Central Bank, or the Bank of England carefully manage the money supply, trying to balance growth and stability. Now that we've broken down what money really is and how we measure it, the next big question is, what happens when there's too much of it? That's where inflation comes in. Click here for the next video, where we'll explain inflation in just 5 minutes. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.